Good afternoon, everyone, and welcome to today's webinar, Managing Your Not-for-Profit Balance Sheet. My name is Lachlan Pollock, and I am the Director of the Festival of Community Directors, which is a governance program run by our community. Julianne Price, the Executive Manager of Schools, Not-for-Profits and Women in Focus at CommBank, is also on the line today, but with the wild weather in Sydney, she unfortunately cannot join us with her voice today. We thank CommBank for allowing us to join them for today's webinar. To start, I'd like to acknowledge the traditional custodians of the lands where everyone is joining us from for today's webcast and pay my respects to their elders past, present and emerging. Today's event is a result of collaboration between CBA, our community and Professor David Gilchrist, co-convener of Not-for-Profits UWA at the University of Western Australia and co-author of the Not-for-Profit Balance Sheet resource, which is designed for directors and CEOs. Before we get underway, you'll have the opportunity to send in questions throughout the webinar, and you should be able to see a section to post your questions on the toolbar on the right-hand side of your screen. There'll also be a survey at the end of today's presentation, which will help us better tailor future presentations to meet your needs. And of course, no presentation that involves CommBank would be complete without a disclaimer, which should now be on your screens. Well, we've got a lot to get through in this session, so without further ado, a very warm welcome and over to you, David.
Thank you very much for that introduction and for the opportunity to speak here today on what I think is a really important topic, and hopefully to also introduce everyone that's listening to our balance sheet tool. So a tool designed to help directors and CEOs of not-for-profits and charities appreciate and understand the use of the balance sheet as part of their governance armoury, if you like, for organisations going forward. Before I do anything else, though, I would like to acknowledge the Whadjuk people of the Noongar Nation and to pay my respects to their elders past, present and emerging, and also to acknowledge all of those First Nations peoples who have shepherded the land on which all of the participants in this seminar are participating from. This seminar then is really an opportunity for me to run through the balance sheet tool, as I said before, and to provide what is really can only be a brief overview in terms of the tool itself and some of the key aspects that I think are really important for volunteer directors, CEOs and others to be thinking about in the context of managing their organisation. So to that extent, the agenda for today is really a bit of how to use the resource, how or what the components of those resources, what the resource is, and particularly going through the major sections. So describing the balance sheet itself, of course, thinking about cash and how important cash is to your organisation's sustainability in the short, medium and long term. Also thinking about asset replacement. And of course, the balance sheet is the repository in accounting terms for recording all of the assets that an organisation has. And so we want to understand some of the decisions around or decision-making processes around how you decide when to replace assets. And then look at things like cash flow budgeting and financial planning moving forward as well. To that extent, I think it's a really important consideration that you do put in any questions that you have. We're very keen to try and make this as personal to the people that are watching as possible and to respond to the key things that you think are important. I'd also like to reiterate that the questionnaire in relation to the content and what's provided here is really important to us to help us to understand how better we can provide information and support to Australia's incredibly important not-for-profit and charity asset. Okay, so the tool itself, you can see the cover here, has been supported graciously by the Commonwealth Bank and developed by the University of Western Australia and my colleague Dana Etherington over at Curtin University. I will step through this resource, but I also will make comments in relation to our research that we undertake here at the University of Western Australia's not-for-profits research team, as well as some of the research undertaken by some of our other colleagues, including Penny Knight, who has undertaken the research annually for 10 years now, the Australian Institute of Company Directors Not-for-Profit Governance and Performance Study, which is also importantly supported by Commonwealth Bank. So two resources that I think are both important to remember that they're out there as sources of information for you, but also to indicate that these are some of the sources that I'll use when I make the comments that I make as I move forward. To that extent then, I would like to thank the Commonwealth Bank for their support over a number of years now in areas that I think are really germane to the not-for-profit and charitable sector, and in two investments for the creation of materials that I think are absolutely critical to maintaining the sustainability of this sector going forward. I'd also like to thank the sector itself for providing so much input into this tool and other tools and materials that we create. Without the sector, we can't make it as germane and as focused as we need to, and we can't make sure that we hit all of the right data points that are important for you in running your organisation. Finally, I'd just like to recognise again my colleague Dane Etheridge over at Curtin University, who assisted in the development of this particular product as well. Okay, so I guess first and foremost, how to use this resource. I guess it's not advice, and it's not intended to be advice. And once you've had a chance to look through the resource, you'll notice that it's really trying to provide a descriptive overview of what's happening in the balance sheet and how the balance sheet works, and to provide you with a set of questions that I think are really helpful in terms of you understanding the balance sheet in the context of your organisation. The audience for this material, though, is very much non-accounting people and people that might be volunteers in the sector as part of the governance team. So that is people that might have different backgrounds, different professional backgrounds, whether that be human services or in charities generally, or that might be in other areas such as medicine or PR and so on. So the audience for this tool is very much a non-accounting audience. The third element to remember is that we also talk about accrual accounting in the context of this report. And accrual accounting is that accounting process where we look to use the accounting reports to tell us not only what cash has come in and cash has gone out, but also how the balance sheet is reflecting the legal performance and position of the organisation in terms of what might be owed or what might be owed to the organisation, just as an example. To that extent, we also talk in the tool about cash accounting, and we recognise that not-for-profits and charities are all shapes and sizes. And because some charities and not-for-profits are very small, cash accounting is a much more effective way to move forward in terms of being able to report your performance and position as an organisation. I guess in relation to dot points 3 and 4 here, we're really saying that you need to look at this tool in the context of, if you like, a proportionate response to the requirements of your organisation. And that proportionate response should be based on the risk that you see in terms of financial sustainability going forward. Some organisations might have significant risk, others might have much less risk, but we'll talk to that too as we go through the presentation. Finally, I guess the most important innovation in this tool, to my mind, are the focus questions designed to give board members, volunteer board members and CEOs the opportunity to be able to ask questions of their organisation. That helps them, one, to understand perhaps what they need to be asking and what kind of information they need to be asking of the CFO or CEO or other support within the organisation. And secondly, it helps them to be able to focus on the key issues that are really important in the context of a proportionate response. And so those focus questions are provided, notwithstanding the answers are probably going to be very different for all sorts of different type of size organisations with different resource capacities. Finally, the tool also has a glossary, which we think is a really important addition to the tool because it allows people to understand what we mean when we're talking about particular words or accounting concepts within the document, but it also might be a glossary that's useful for boards themselves and CEOs to adopt within the organisation so that everyone's on the same page and they understand the same things by the use of the same descriptive words. So the final point that I think is really important is that it's absolutely critical that board members, CEOs and others that are charged with governance of not-for-profit and charitable organisations feel confident to get advice. This is not advice, it really is a framework for you to explore the balance sheet more thoroughly within your organisation, but there's nothing wrong with boards using resources of the organisation to go out and get appropriate advice from the accounting profession or otherwise to be able to help you through this process. Okay, so what does the resource do? Specifically, it describes the purpose, nature and governance of the balance sheet. It focuses on those untrained in accounting, as I said before, and it suggests those key focus questions that are absolutely critical. The description of the purpose, nature and governance of the balance sheet, I'll touch on shortly in a minute. In terms of those focused questions, I think it's important that you actually have a look at the tool and consider those questions as they apply to your organisation. Really then, the tool is intended to be a starting point to help you to work through your balance sheet and your organisation's financial sustainability in the short, medium and long term. So the structure of the resource is fairly straightforward. There are 4 substantive sections, each looking at the balance sheet itself, cash, asset replacement decisions and financial planning. We will look at those elements in a short second, but I guess the first thing we need to do is to make sure that we're on the same page in terms of what this tool is focusing on from a reporting perspective. The management balance sheet versus the reporting balance sheet is a really important consideration for organisations. When we report our finances to stakeholders, when those finances are audited, so a financial report is published, that takes on a particular role, but is also constructed in a particular way that allows those people outside the organisation to understand what's going on. In other words, often we apply accounting standards, but even if we don't apply accounting standards to the balance sheet, we do tend to create the balance sheet in such a way that people outside the organisation would recognise the components and understand what the balance sheet is telling them. On the other hand, this tool is focused on the management balance sheet, and the management balance sheet can be constructed in any way that is suitable to the management of the organisation. In other words, it's not intended for the management balance sheet to be published, and it's not intended for it to be in a particular format. It's whatever is needed to be developed in order to support management, the board, and other stakeholders within the organisation to make decisions that they need to make. So that's the first point. We're not talking about accounting standards, and we're not talking about publishing the balance sheet. We're talking about its internal use. The other element that I think is really important is the context of timing in accounting. Unfortunately, accounting is very much a binary timing idea. That is, at the end of the day, we tend to consider everything to be either current or non-current. If it's current, it means that it's dealt with within the current year or the year coming, so that an asset, as a current asset, will be converted to cash at some point in the next 12 months. On the other hand, if it's a non-current asset, say a building, we wouldn't expect to convert that building to cash within the next 12 months. That makes it non-current. So when I say it's a binary consideration in accounting, we only have 2 temporal frames or 2 time frames that we consider things in. One is current, one is non-current. One relates to what happens over the next 12 months. One relates to what happens beyond that 12 months. This is not necessarily as helpful a dichotomy or a split as you might think, because of course, even though something might become cash in 12 months time, current liabilities or creditors might need to be paid before that cash is converted. So it's really important not only to think about timing for a management balance sheet in terms of current versus non-current, but also to think about it in terms of working capital requirements, how much cash you need, and we'll talk about that in a little while. The final point is around sustainability, and I think this is a really important consideration too. The balance sheet, of course, is an accounting tool. It's an accounting report, and as an accounting report, it's really focused on the finances of the organisation, the cash in, the cash out, the assets and the liabilities. This is really important, but it doesn't necessarily equate fully to sustainability. And in fact, when I talk about sustainability, I'm talking about the organisation's ongoing capacity to deliver on its mission. That is, to provide the services in the quality and quantity required, in the timing required. That is sustainability for a not-for-profit and charitable organisation. The balance sheet, of course, is critical to understanding that capacity for sustainability, because without money, without assets and liabilities, the organisation can't hope to be sustainable. But I guess what I'm saying here is that sustainability and dollars is not the end of the discussion. It's really the start of the discussion, making sure you have resources to then progress to be sustainable. The other element of sustainability that I think is really important is that we need to start to think about the short, mid and longer term aspects of sustainability, and these are set out in the tool as well. So solvency, for instance, in the short term is critical. You've got to be able to pay your bills as and when they become due. If you can't do that, then your opportunity for mid or longer term sustainability, of course, is going to be challenged. In the mid-term, sustainability relates to being able to continue to provide those services that meet the quantity, quality and timing required in accordance with your organisation's mission. While the longer term sustainability is represented by your ability to be able to replace assets and also invest in your organisation to retool it to confront change. So things like the NDIS, aged care, the Royal Commission's outcomes, all of those kinds of things are going to have impacts for many charities around Australia. To be able to have sufficient financial resources, as well, of course, as human resources capacity, to be able to meet those challenges and to retool your organisation accordingly is an absolutely critical part of sustainability. So I guess just to recap in this particular slide, the idea of sustainability revolves over a short, mid and longer term perspective or strategic horizon, and we need to think about sustainability and the balance sheet in that context. So what is the balance sheet? I guess many people in the audience would have come across a balance sheet in one way, shape or form as part of their governance responsibilities in their daily work or what have you. Essentially, the balance sheet is divided up into three fundamental sections. The first section is assets, the second liabilities, and not shown here is equity, which is the net wealth of the organisation, if you like. In terms of assets, we divide assets into current and non-current assets, as you can see there, and we divide liabilities into current and non-current liabilities. And remember that comment around time and the binary nature of time in accounting when you're thinking about the context of these two types of things. I've provided in this chart examples of those elements as well, but I just wanted to touch on here very quickly accounting estimates. Accounting estimates can be assets or liabilities, and generally they represent those things that we don't know how much they're going to be worth or what they're going to cost the organisation, but that represent our estimation of those elements. Typically though, accounting estimates are liabilities for organisations, and by far and away the most common example of those accounting estimates are things like employee leave entitlements and also depreciation. Employee leave entitlements are accounting estimates because we know how much time employees are accruing, but we don't really know how much it will cost us to extinguish that leave in due course. This is because, of course, employees continue to be employed, may get promoted or may get pay rises, and that changes the cost of those leave entitlements to the organisation, even though they might have been accrued some time back. Therefore, leave entitlements are accounting estimates, but incredibly important accounting estimates, as you know. The other accounting estimate that is commonly identified with the non-current assets of an organisation is depreciation. And depreciation is an important non-current asset because it helps us to appreciate the reduction in the value of an asset that occurs over time as we slowly consume that asset through undertaking the activities that we undertake. Things like buses, buildings, all of those things, as we all know, depreciate because they get worn out, they get used up. And depreciation is intended to be an estimate of that used upness, if you like, if I can use that phrase, or to the extent to which the asset is worn out. In other words, we're trying to assess the extent to which the asset is worth something over time, but also to be able to understand when that asset might need to be replaced. So in terms of sustainability then, I guess a couple of things need to be considered. First and foremost, traditionally in accounting, we're very keen to ensure that we have more current assets than current liabilities. In other words, when we think about liabilities and assets, we need to match off current assets with current liabilities to ensure that we're covering off those current liabilities and we're going to be able to pay them in due course. The corollary, or the other side of the coin there, is that, of course, more non-current assets need to be amassed as compared to non-current liabilities. We like to ensure that the wealth of the organisation is in positive territory, and while a not-for-profit or charity's purpose is not to accrue assets for the fun of it, for the wealth of the organisation per se, it is absolutely critical that you've got the asset resources to be able to pursue your activities and mission over the short, medium and longer term. The other thing that's really critical to the balance sheet, and it might not be as intuitive for many people, because of course the profit and loss report or the income statement is where we report profit. But profit's absolutely critical to the sustainability of an organisation and critical to the building of the balance sheet. Once we make a profit, that profit then becomes part of that net wealth in the balance sheet and builds the capacity in terms of establishing cash reserves, having working capital to operate, or it might even be in terms of replacing assets or investing otherwise into the organisation. Profit is a very difficult thing for organisations to consider though, particularly in the not-for-profit sector, as determining what an appropriate margin is a really difficult thing. I'll come back to this at the end of the presentation, but suffice to say here that you really must create at least sufficient profit for your charity or not-for-profit organisation to be able to ensure sustainability. And that means ensuring a profit that's at least as substantial as the profit, as the cost of doing business under CPI, health CPI, or one of those kinds of metrics. So timing is really important. Non-cash items such as prepayments and income in advance are really important things to consider. They're important for two reasons. One, because we grade them as assets and liabilities, but also because we don't necessarily see more cash flows in relation to them. One of the key things that I think does get people into trouble in terms of not understanding their balance sheet sufficiently is when you get income in advance. That is, you get income from a funder, but you haven't provided the services for that funding. You need to isolate that income to make sure you've got resources to supply the services or goods that have been purchased in that arrangement. Otherwise, the organisation is going to have a cash difficulty at some point in the future. Okay, so accounting estimates, just a couple of comments in relation to those. Estimates need to be made relating predominantly to future expenditure. They can be assets, but predominantly they're related to future expenditure. This is part of the balance sheet being used to help you understand the extent to which you might be sustainable in the medium or longer term as these kinds of expenditures become more important. Long service leave and annual leave, I've already identified as being a accounting estimate that needs to be taken into consideration. That long service leave and annual leave are significant time bombs in some organisations' balance sheets. The longer leave goes on, or the longer leave is accrued without being taken, the more financial difficulty there's the potential for the organisation. And depreciation, which I've already identified as well, is an absolutely critical part of the calculation for sustainability going forward. It helps boards, CEOs and other stakeholders within the organisation understand just how well those assets are holding up in time and how likely those assets are moving towards redundancy, if you like. They're needing to be replaced. So to that extent, I guess the risk in relation to the balance sheet is that you don't disclose the full potential costs that are associated with operating the organisation. Now, in small turnover organisations with relatively little cash flow issues, this may or may not be a problem. But in some large organisations and organisations where you do employ staff particularly, or you have significant assets on hand, these expenses really need to be estimated in order to ensure that you're going to be sustainable in the long term. The second thing that's really critical is that you need to make sure the board is aware of the nature of these estimates and how they work, how they're calculated and what they mean. Particularly, I think it's important that leave balances are reported to the board, and that allows the board to understand the extent to which there are leave problems building up in their balance sheet and the extent to which those people that have leave entitlements are taking those leave entitlements in a timely fashion. And in fact, creating a leave policy is a really critical part of managing your balance sheet in that regard. In not-for-profits and charities, human resources are the most expensive element. They cost a lot of money. They are up to 75 or 80% of total expenditure of an organisation, and particularly in human services, of course, they're very human resources based. We need people to do those services, and therefore to establish a leave policy, and particularly to ensure that leave is taken on a timely basis, is a absolutely critical part of managing your balance sheet moving forward. So what are the balance sheet issues? Some of the things for directors, CEOs and others to consider, both in terms of the internal balance sheet, the management balance sheet, and also, to be frank, when you're looking at balance sheets that might be published for other organisations. The first issue is around valuation, valuing the assets particularly, but also accounting estimates like depreciation and leave entitlements require you to make arbitrary valuation decisions, and that can be a great difficulty if you get them materially wrong, because that can either see you reporting a greater amount of liability than you actually have, or perhaps worse still, reporting an undervaluation of liability and therefore setting up the organisation for a sustainability issue into the future. Directors are able to value assets and have policies established to value things like leave entitlements and depreciation, and you should have those policies in place if you have a substantial balance sheet for your organisation. Again, if you have human resources, that is, you have staff employed, even if it's a small organisation, you need to be focusing on valuing the leave entitlements to make sure that you're going to be able to pay for those in due course. So the other aspect of valuation for things like leave entitlements and depreciation relates to timing, making sure that you are not only valuing those elements appropriately, but that you understand the timing for their replacement or their ultimate payment. And again, this is also arbitrary and takes a bit of guesswork. But often we say in accounting, looking at past history is a great representation of what's likely going to happen into the future. And therefore, when we think about timing for leave and other things, it's important to look at your accounting history to see what's occurred in the past, and then to assume, unless you undertake some significant policy change and you police the implementation of that policy, that those timings are going to apply going forward. The other element that is really important in this area relates to completeness. And by completeness, we mean that the balance sheet contains all of the assets and liabilities that it needs to in order to give you a good perspective of the net wealth of the organisation and the current assets and liabilities and non-current assets and liabilities. So making sure that all of those assets are listed, all of those liabilities are listed, is an absolutely critical part of balance sheet management. So I guess the risk there is if you don't value correctly, if you don't assess timing and budget timing correctly, and you don't have a complete balance sheet, then the risk is that the balance sheet does not disclose the full liabilities. Of course, the other side of the coin is that the risk might be that the balance sheet discloses too much in the way of liabilities and gives a false representation of the financial position of the organisation. If that's the case, that's also bad. We want to be conservative, and by conservative it means we want to get the balance sheet values, timing and completeness as close to right as possible, not as close to the worst case scenario as possible, and I think that's a really important aspect. That doesn't mean that you can't have a management balance sheet version that shows the worst case scenario as well. That might help managers and board members to make decisions around strategy and other aspects. But we want a conservative balance sheet that we make decisions from. That is, that it's as close to the likely values, timing and completeness as it possibly can be. We also want to make sure that we are across all of the sustainability issues over time. So we not only should be looking at the balance sheet today, but we should be forecasting the balance sheet for the end of the financial year, and perhaps importantly forecasting that balance sheet at the end of the next financial year and subsequent financial year. That is, we start to take a financial planning view over time rather than an annual budgeting view. This will help us to ensure that there are no sustainability issues hidden in the balance sheet that we haven't recognised. The other balance sheet issue that's really important for charities and liability and not-for-profit organisations is that of administered versus controlled assets. Charities and not-for-profit organisations, as we all know, often receive assets directly from philanthropists or lotteries, lottery commissions and other lottery regulators in the states and territories. And those forms might be in the actual handover of the asset, or it might be in the form of providing cash to purchase the asset. When you have those assets handed over, or when you receive that cash, generally speaking, there are a number of caveats around how that asset might be used, and particularly importantly, how that asset might be disposed. Some philanthropists and some lotteries arrangements or other funding arrangements stipulate that assets, for instance, must be used for a particular program, and if they're no longer useful for that particular program by that organisation, then those assets have to be handed on to somebody other, some other organisation that's conducting that same program. Those of you who've been in the sector for some time might recall that the Commonwealth-funded HAC arrangements were very similar in that regard. Those kinds of assets are what we call administered assets. So those assets that come with chains or difficulties in terms of their complete use. You can't sell them. You might have restrictions as to how you use those assets. They're called administered assets because you're applying them to pursue your mission, but you can't unnecessarily say, okay, they're on the balance sheet, therefore our worst case scenario is we sell all our assets and we're going to retain our sustainability going forward. On the other hand, controlled assets are those assets that you own that are absolutely free to be used and deployed as you wish, and ultimately to be sold or in some other way devolved as you wish as an organisation. So two distinct types of assets are really critical to be able to understand what's going on. If you don't understand the difference between administered and controlled assets, then you may well miscalculate your ultimate solvency, because you might take into account, as I said before, those administered assets that are actually not for sale, but thinking that you might be able to sell them. A warning here, often auditors who predominantly audit commercial organisations or government organisations may not trig that you have administered assets in your organisation, and also sometimes directors and others in the organisation, as time moves on, forget that those assets are administered or have those kinds of caveats over their use and disposal. Therefore, you might end up misusing assets, which of course is not good from a funding and replacement perspective. And of course, not-for-profits and charities don't want to see administered assets misused, because reputationally that doesn't help their cause down the track. Ultimately then, I think it's really important that you consider splitting your controlled and administered assets for better reporting within the management balance sheet. The other element that I just want to get to in talking about the balance sheet itself and our understanding of the balance sheet is in ratio analysis. That is that process where we use ratios to be able to understand the combination or the relationship between particular assets and particular liabilities. For instance, many people might be aware of the current ratio, which divides current assets by current liabilities in order to show how many dollars of current assets you have compared to current liabilities. It's a very commonly used ratio and an important tool to be able to identify interest, areas for further interest or investigation. But remember, it's only a pointer. Ratios are only ever used to give you an idea of how things are going and to help you to identify where you might apply your time. Ad hoc ratios can also be used where, for specific organisations in specific industry types, you might develop your own ratios in order to help you to understand your balance sheet better. At the end of the day, you need to create, though, a set of decision points around ratios. That is, that you have a policy framework that says when our current ratio, for instance, so our ratio of current assets to current liabilities gets to a certain point, then the board needs to be informed and we need to review our budgets to make sure that we're going to have working capital to retain the organisation's sustainability going forward. The other elements, I guess, are all identified here in relation to the balance sheet elements themselves, so cash, debtors, inventory, and so on, and what kinds of risks those elements represent, and also some of the governance arrangements that might be put in place in relation to those elements. So, for instance, the first one, risk. Your risk, of course, in relation to cash is that you can't meet outgoings, and we tend to use the quick ratio and cash flow budget to help us to manage that particular risk. The quick ratio, for those people who've not heard of that before, is similar to the current ratio, but it just takes your cash assets and divides them by your cash liabilities. Of course, we want to make sure at all times that we have more cash assets than cash liabilities in order that the organisation retains its sustainability. I don't plan to work through those, however, these slides will be available, and it is worth revisiting each of these to make sure that you feel confident about how you're reviewing your budget, your balance sheet rather, from time to time, and how you're governing that balance sheet particularly. The second section, and I'm talking fairly quickly to get through all of the material because we want to make sure we cover it all off, relates to cash. And particularly I wanted to talk here about working capital, which is a really important aspect of cash flow. Working capital is important for two reasons. One, because you need to have cash in your bank for employees, to be able to pay your creditors and so on, as and when those payments become due. But you also need, because that working capital instance, not earn as much money if it's sitting in your check account or your operating account, as opposed to being invested for the benefit of the charity or not-for-profit organisation. Generally speaking though, the working capital cycle is something like this, where we provide a service, and say NDIS is a great example. You provide a service, you pay your staff, you tend to pay your creditors, you invoice the NDIS for the funds that you need in recompense for the services you provided, and ultimately NDIS pay. As you can see, we have a floating cash balance, something above zero, according to that graph, but how far above zero is really a matter of policy and risk management for the board and for the CEO and others within the organisation. Having said that, as I mentioned before, the bigger the amount of cushioning you've got in your bank account, the less efficient the use of that cash is. And therefore you want to always be careful to make sure there's sufficient cash, but at the same time, not too much cash in your working capital profile. So one of the things that we need to think about then is making sure we have target cash levels, and this can include reserves. Organisations, not-for-profits and charities often carry reserves. I think it is really important that if you do have reserves, that you identify those, the purpose of those reserves very clearly, that you identify the parameters of those reserves, so how long you'll hold on to the cash, what the maximum balance of those reserves should be, for instance. And also, even though we're not talking about the published balance sheet for your financial reporting, that when you talk to stakeholders about those reserves, they understand what they're for as well. You don't want philanthropists and other people making assumptions about your cash reserves and suggesting that they don't need to support you anymore because you've got the cash on hand. Of course, you need reserves to be able to pay out those accounting estimates and other investment that you need to make in the short, medium and longer term. You might have to think about reporting those cash outcomes, and particularly from the board perspective, ensuring the board understands the cash movements of the organisation. As much as accrual accounting is really important to understand our accounting position and our accounting performance, at the end of the day, cash is absolutely critical. And so the board needs to be very comfortable that they have sufficient cash and sufficient cash flow in to be able to support themselves. So in reporting those outcomes, two things come to mind. One is making sure that debtors are paying on time and creditors are being paid on time, but also making sure that the organisation is sufficiently profitable to bring cash into the organisation. And from a profitability perspective, I guess a key issue is making sure that that profit ultimately turns into cash for the organisation, because remember, we calculate profit using accrual accounting methods. So current cash flow needs are absolutely critical for solvency, to replace assets in the longer term, so critical for sustainability, and also to invest in the organisation to be able to support change and respond to the environment and context within which the organisation operates. At the end of the day though, cash is king. You absolutely have to have cash, and your balance sheet is your first port of call to understand your cash position as a director or CEO of an organisation. The third major section is that of asset replacement. And asset replacement and forecasting is part of that financial planning process. So I mentioned financial planning before in discussing the assets of the organisation. Financial planning process is really looking at the financial movements of the organisation over a 3 or 5 year period. Most organisations are really, really good at budgeting these days. There's very few not-for-profits and charities around Australia, I would suggest, that don't have a strong annual budget process and that don't report against that annual budget on a regular basis. However, financial planning is probably somewhat weaker in the sector, but it equally is important, particularly when we consider the balance sheet and for the reasons I mentioned before. In terms of short, medium and longer term horizons, understanding what cash is going to be required to keep the organisation able to pursue its mission in the short, medium and longer term is an absolutely critical aspect of that financial planning process. So I guess there's two questions there. One is, where does the cash come from and where does the cash go? Importantly, when we're thinking about financial planning for the balance sheet, we're not just thinking about income and expenditure and ultimately profit, we're thinking about where capital cash might come from to be able to support purchasing of assets and so on. That capital cash often comes from philanthropists, it often comes from charities and other regulators and government entities, but I think one thing is absolutely clear, that increasingly all of those sources of funding are becoming more and more stretched. COVID certainly brought to light some key issues around getting cash out to organisations, but I think it's absolutely critical that charities and not-for-profit organisations consider whether or not they can rely on philanthropy, lottery services and other services to continue to maintain the value in their balance sheet moving forward. By value in balance sheet, I mean their capacity to be able to be sustainable in the short, medium and longer term. So at the end of the day, I think a 5-year horizon, budgeting your balance sheet for 5 years forward is a really critical thing, because it will help you to understand the extent to which there might be some issues in your balance sheet beyond the current budget period. Remembering the decisions you make today impact the balance sheet going forward. The other aspect is where you replace your assets, and some of the principles to consider in the replacement policies of your organisation are suggested here. Again, I don't propose to go through every element here, but rather just to acknowledge the replacement principles down the left-hand side, which I think are really important considerations for CEOs and for those on boards, amongst other people involved in your organisation. That is, we need to replace our assets if they're unserviceable, they're unable to be able to do the things we need them to do. Perhaps more importantly, in some forms of charity, unreliability is a more important issue. If we have assets in place that might be required to ensure the health of people, for instance, or where we might make sure that transport or otherwise those people need to be continued to be supported, if an asset is unreliable, then we would look to replace that asset on a risk management basis. Of course, we might replace assets too because those assets don't allow us to become accredited in the eyes of a regulator, for instance, in the case of aged care and aged care facilities. But we also might remove assets or sell assets because those assets are no longer applicable to our organisation and what we do. And then finally, we might see that there are high risk assets that we replace on a regular basis, regardless of whether those assets are expected to continue to work well or not. An example here might be the tyres on a motor vehicle. You might not wait until the tyres are absolutely bald, rather you might have a policy in place that requires you to replace tyres every 3 years, regardless of the state of those tyres, in order to make sure that the tyres on a client motor vehicle are serviceable and are going to reduce risk of an accident as much as possible. The final point that I wanted to go through is cash flow, budgeting and financial planning. And I've already spoken to financial planning a fair bit, but I want to make some further comments that I think the tool will help you with. First and foremost, as I said before, budgeting is absolutely well established within not-for-profits and charities around Australia in my experience. And budgeting means not only forecasting what's going to come into the organisation over the next 12 months and what's going to go out, but also making sure you use that budget to assess performance of your organisation over time. Financial planning is less of an issue in that regard. We're looking at that longer term aspect of how the organisation is going to operate. And I've already spoken to financial planning and planning for the balance sheet over a 3 to 5 year time period. I think that 3 to 5 year is absolutely minimum. 3 years certainly is critical. And in that regard, I guess components of the financial plans relate to the annual development of your operating budgets, the updating of your cash flow budget and capital budget, but also then moving into your asset reinvestment plan, employee entitlements, payments estimates, and loan capitals for that ongoing development. And then the annual update of the financial plan is absolutely critical. Again, I don't propose to go through each of those components, but I did because I do want to leave just a couple of minutes for questions. But at the end of the day, I think that financial planning consideration is critical element of managing your balance sheet and making sure you have that sustainability capacity in the short, medium and longer term. Thank you very much. I'm very happy to take any questions that there might be.
Thank you very much, David, for that. We're just waiting for a couple of questions to come through. So if you have anything that you would like to ask David, please just pop them in the chat or the questions tab that you'll find on your GoToWebinar control panel.
I guess just while we're waiting, and there might not be some questions because there was a heck of a lot of stuff in that presentation, I understand that. But I would say that there's a further issue to consider, and that is your the cost of your budgeting and financial planning process compared to the advantages that might come with it. All accounting is a cost to an organisation. And so the important aspect from a decision maker's perspective is that that accounting and reporting process deliver information that delivers far greater benefit than the estimated cost of creating it. And I think that's also a really important thing to consider. When you look at your balance sheet and you look at your planning processes and governance processes, it's all about proportionality, making sure that the proportion of work done to manage your balance sheet is at least equal to or less than the value that you're getting out of that particular process. So consider the proportionality as part of your decision making, and particularly as part of your use of the tool to make sure that your organisation is not over investing in this area as well.
Thanks, David. We do have a question here, and this is from Ian, and he is just wondering whether there is a generally accepted formula for estimating leave balance liability moving forward.
Yes, there's two forms, and this is very general. Two forms. One form is an actuarial form, which particularly larger organisations with lots of staff often have an actuary's report on leave extinguishment of liability. That is when we're going to pay leave out over the short, medium and longer term to try and arrive at a valuation. I guess what I would be looking at in terms of leave liabilities for most other organisations, though, is forecasting two things. One, when the leave should be taken, and having a leave policy is critical to making sure that everyone's aware that they need to take their leave on a timely basis. We would expect that people are actually going to take their leave when it becomes due, if not as soon as possible in the following year, so that we're not accruing leave liabilities, but importantly, we're not accruing leave liabilities at the higher rates of pay that are likely to apply in future periods. So making sure that we are calculating that leave prospectively, I think it's really important to do two things. One, to make sure that you calculate when people take leave at the outer limits, if you like, of your policy arrangements. So expect people to take leave at that outer limit. And then two, to be able to use a value for that leave that's based on your conservative estimate of what the increase in pay might be for those staff over the next 12 months, 2 years and 3 years. By conservative, remember, I'm not talking about worst case scenario, I'm talking about the most likely scenario, so the most appropriate calculation to be able to work out whether or not that leave balance is going to be repaid and what it's going to cost the organisation.
Fantastic, thanks David. We have another one here. What are your thoughts in relation to recording intangibles like goodwill and IP on the balance sheet?
So as an accountant, recording goodwill and IP on the balance sheet is critical because it allows for that asset to be recognised by people reading that document, particularly external readers of that document. It allows them to be able to understand that you're claiming certain assets that are intangible, such as patents or other things. Internally, I think it's important to recognise those assets, but equally important to recognise that their value is really difficult to arrive at. And so you don't want to be spending, in the context of that proportionality I was talking about before, you don't want to be spending a lot of time valuing assets like that unless there is a likelihood that you're going to sell that asset or in some way trying to convert that asset into cash. If you're selling it, then obviously you've got to go out and get a valuation as the best way forward. But if you're not selling it, then those intangibles should be on the balance sheet, but probably represent an area of the balance sheet that you put the least amount of work in terms of ensuring the valuation's correct, because at the end of the day, you're not going to necessarily sell those things or to be able to rely on those things for sustainability in a direct sense going forward.
Great, thank you, David. Another one here from Paul. Should administered assets be identified separately on the balance sheet and also reflect a liability, given it is a conditional asset and should be depreciated?
That's a really good question. So they should be identified on the balance sheet as administered assets. In strict accounting terms, they meet the definition of asset. So an asset doesn't even have to be owned by an organisation to be an asset. It is the criticality of defining an asset is that the particular item can be used by the organisation to pursue profit or to pursue its mission or whatever it is it does. So therefore, even though an asset that has caveats over its use, that's restrictions over its use, it does represent an asset. It is fair to allocate it to the assets in your organisation's balance sheet. Having a countering liability is not really appropriate for these types of assets on two counts. The first count is that often those caveats are only extant for a period of time. That is that, for instance, in Western Australia, where I'm from, our Lotteries Commission might pay for a building for you. Typically, that building and land can't be sold or converted to another use for 10 years. After 10 years, it becomes a controlled asset and you can do what you like with it. In the meantime, it's administered. So really, technically, there's no liability there because as long as you keep using the asset for its purpose, you're not creating a liability in that regard. I understand why you might consider that, because what you're trying to do is to come to a net wealth position of the organisation. But I think in strict terms, being able to differentiate the administered assets from the controlled assets would give you that control or that understanding without necessarily having to introduce a fictitious liability to counteract that value, and particularly because those assets are likely to become, in most instances, controlled assets with the effluxion of time.
Thanks, David. Another one here we have is, how should we treat volunteer hours as a not-for-profit organisation?
This is a really important possible topic for another seminar. Actually, there's so many aspects of this that are really important. Look, I think I would do two things. One, I would look at what other organisations within my subsector are doing with respect to reporting, only to have an understanding or an appreciation, if you like, of what kinds of things stakeholders might expect to see in a financial report of your organisation. But secondly, I would give I'd probably be very cautious in terms of trying to estimate the values of volunteer time, because I think at the end of the day, the proportionate value of that to your governance process and communications process is probably very minimal. In other words, when we recognise volunteer time in the profit and loss, we don't recognise it in the balance sheet, then we have to estimate the income that represents, because we're getting a whole lot of free hours, for want of a better phrase. And we also have to represent the consequent expense, because we're consuming that time as well. In other words, representing volunteer time on the income statement or profit and loss doesn't actually moderate the profit, because our income is the calculated value of those hours, and our expenses is the corresponding calculated value of those hours, because they're consumed. So in terms of management accounting particularly, I'm not sure that it brings much value. And in terms of external reporting, I think it's probably better in your annual report to have a matrix of how many hours and what types of volunteers and what have you in your commentary, rather than muddying the waters of your income statement in relation to that. The other aspect to consider too is the prospective impact of charities that are registered with the ACNC, who might see themselves placed in a higher tier because they're estimating their income to include volunteer time. And I think that's a really important consideration too, because of course the tiering is allocated based on your turnover, your income, not on your expenses as well. So there wouldn't be a corresponding reduction there. And that might mean that you have more significant reporting requirements as a result of falling over the line into a new tier.
Thanks, David. And if we have time, we'll go through one more question. This one is, how often would you suggest re-evaluation of real estate?
Look, I think it's quite critical actually. So if you'd asked me that question 5 years ago, I probably would have said to you, having a revaluation every 2 or 3 years is sufficient for most organisations. But I think that around Australia, all of the capital cities have experienced quite significant fluctuations in real estate markets that might make valuations much more rubbery these days. I'd say there's two aspects or two further responses that I'd like to give. The first one is that if it's real estate that is what you might call vanilla commercial real estate or vanilla domestic real estate, then I think your valuations can be based on a simple drive-by by a real estate agent every year. And then, of course, perhaps a revaluation every 5 years that is done by a valuer and perhaps a more substantive piece of work. On the other hand, if you've got very specific types of organisations or types of assets in your organisation, so things like aged care facilities, workshops or other arrangements in place that support a particular disability or a particular human service need or requirement, then it might be that you need to have a specific valuation, because it's very hard to go out to the market to test that. And therefore that valuation might be done every 2 years or every 3 years, depending on what you're using that valuation information for. For instance, if you're wanting to go out to get a loan from a bank, then the valuation would have to be undertaken at that point in time in any case. If, on the other hand, you're looking to sell that asset, then you need to get a formal valuation when you come to sell the asset, or as formal as appropriate for the size of the asset. So I think there's a number of answers to that. But if you are not looking to use the asset in terms of selling it, if you're not looking to loan funds using that asset as a mortgage asset, then you might find that simple valuations like looking at the market or having real estate agents drive by are the best solution for most years, with a formal valuation every 3 or every 5 years, depending on the nature of the assets.
Fantastic, David. I think we'll wrap up the questions there. We're just about hit time. So Just like to say many thanks, David, for your time and your insights, and thanks to everyone else who attended today's webinar, and a big thanks to Commonwealth Bank for your continued investment into the not-for-profit sector. There's a whole lot more info in the tool, and it is a really great tool, and I know that a lot of you have reached out asking where you can find this. I'll ensure that a link to the tool is sent out to everyone this afternoon, along with a recording of today's webinar and the slides used. I'd like to quickly also note that this webinar is a part of a series of webinars we'll be running with CBA and David this year. So be on the lookout for the next one on the calendar, and I'll make sure everyone who registered today is among the first to know when everything is ready to go. Just a reminder that we have a survey that will pop up on your screen when I close this session, so it would be great if you could fill that out for us. Thank you, everyone, and enjoy the rest of your day.
Thank you very much.